Hello and good afternoon, everybody. My name is Rick Anthony. I'm with DSP. We're a global company located in London. And today we have with us Helene Abrams, which will be discussing the 5 criteria for designing a chart of accounts. And one of the reasons we, as a company that specializes in e-business, wanted to bring this information to you was in implementing global e-business across many countries. We found that there was a sense of disparity sometimes between what other countries need and what was actually required. So we've partnered with eprentise and coming up with a webinar here, but also some true life stories as well. So just a brief on DSP. Again, we're an operation in London. Don't let my accent fool you. We are London-based and with global implementations. And next slide, please. Next slide. Thank you. And I'm not going to tell you more about us than what's there, which is our Oracle practice. We've won numerous awards, e-business partner of the year by the UKUG, database partner of the year, managed services. And for e-business, 4 years running, winning partner of the year around that. So again, this just gives us a sense of why we are able to talk about this in a qualified manner. So without further ado, I want to turn this over to Helene, which is going to provide you a lot of information on the chart of account structure. Helene?
Thank you, Rick, and thank you all for joining. Thank you, DSP, for hosting this webinar. A little bit of background, eprentise has software that allows you to change anything within the e-business suite. It started in 2007. I'm Helene Abrams. I'm the CEO and founder of eprentise, and we started with the idea that I was Oracle's first apps consultant in 1988, and when I first started, after Oracle, I went to Deloitte and then E&Y. We'd have many, many large customers who would have 150 sites, 300 or so consultants, and every time they needed to make a change because of a business change like a merger, acquisition, divestiture, or a basic change to the structure of eBusiness Suite like a chart of accounts, a calendar, or had multiple instances, they needed to re-implement. So we would go live in the first site, go live in the second site. By the time we got to the third site, something had changed in the business. So we came up with this software that allows you to systematically and with software change all of your underlying configurations, consolidate your instances, separate data for a divestiture, merge or split legal entities, ledgers, operating units, and it's all software so that our customers can avoid a reimplementation. We're happy to present today on designing a chart of accounts. Also, I am happy to, if you have additional questions specific to your companies or your environments, we'd be happy to work with DSP and schedule a no-charge design session to talk about your specific chart of accounts and how you can change it and still stay supported by Oracle. So we're going to be talking about the 5 fundamental design criteria for a forward-thinking chart of accounts. That's because your business is constantly changing, and you need to be able to grow and expand and report different things in different ways. Objective 2 is learn how a good design reduces costs, streamlines reporting, and provides global visibility. And then finally, we're going to talk a little bit about the Release 12 features like subledger accounting and ledger sets, and how a global chart of accounts can be used to standardize your financial activity around the world. So I'm going to first, we've done the introduction. I'm going to talk about chart of accounts basics, then the 5 fundamental criteria for a good design, how you accommodate future growth, reduce costs, and then leverage Release 12 features. So the basics are you have an accounting flex field, which is your chart of accounts in eBusiness Suite. It has different segments. You may have up to 30 segments. Each segment may be 25 digits in length. And within each segment, you have an unlimited number of values. And when those values are strung together, that's called a code combination, or a CCID. As I said, it accommodates up to 30 segments, and it's really used to categorize your financial transactions. You can think about it like columns in a table, and by and large, they should answer the questions of who, what, where, why, and possibly how for each of your segments. One of my criteria is that your segments are defined so that anybody coming into the organization will know how to find and search for and report on the information in your financial transactions. Some common segment examples are cost center, department, fund, location, product line, line of business, so on. You see those flex fields in many, many forms in eBusiness Suite. Here are the code combinations. This is the accounting key flex field, and then at the bottom of this screen in EBS, you see the descriptions. So here we have 1, 2, 3, 4, 5 segments. Our first segment, 01, is operations. 000 is a default. There's no department for this transaction. The next one is your inventory material value. There's no sub-account and no product information on this first line. Within each line of that, you record debits and credits, and then Oracle takes that information and calculates the balances and calculates your cash on hand, how much you've spent in each category of information. The accounting flex field also incorporates parent-child relationships within each segment among values. There are 2 ways to think about this. The first is a roll-up group, and that is a collection of parent values for a given segment. In the account segment, you often have your assets account or your cash accounts, and then you have other detailed accounts that roll into that. That is used for creating summary accounts, and your lowest level detail is the one that you post and budget to. And then it rolls up into a parent value for your reporting. A summary account is, for a summary account, Oracle, for those parent accounts, will calculate a real-time balance. What that means is that every time you post to a detailed account, Oracle recalculates the balance for all of the children that roll up to that parent account. It's necessary sometimes for banks who need to report real time. It does lead to faster reporting. There's a downside to having summary accounts, and that is that every time you post, it has to recalculate all of your balances. It recalculates either in detail or in summary. And of course, if you have 10,000 accounts, recalculating those balances can take a very long time. So it slows down your posting and you're entering your day-to-day transactions, but it does speed up your reporting. So I'm going to be talking about each of these 5 criteria as we go through, and I have examples and discussion about those. First is that there's only one type of information in each segment and only one segment for each type of information. Second, information in the chart of accounts is not repeated from other modules. There is enough room to expand within each segment. Your summary accounts and your roll-up groups fall naturally within ranges. And then, this is my favorite, you're able to report on critical business components with standard EBS reports without resorting to spreadsheets. FSG's, financial statement generators, and other reports should be easy to create. So let's go through each of these, and I'll give you some examples and go through why this is important. One type of information per segment and one type of information only in a single segment. For those of you who are database designers, relational database, this is normalized. And information should not overlap across segments. So if each segment contains one and only one type of information, you reduce the maintenance of keeping information in multiple places and reduce the possibility of introducing errors into your accounting. So if you have 2 segments in your chart of accounts, cost center segment and business unit segment, and they have the same kind of information, there's no need to have both segments there. Because otherwise you have to then write a cross-validation rule to make sure that those are always the same, or you're going to have cost centers and business units that don't align. And then you only have one type of information in a single segment. So if you have a department segment, HR, you don't want to have an HR Sacramento, an HR New York, an HR London, if there's also a location segment in the chart. It's much cleaner to have one HR department and then have a location segment that tells Sacramento, London, Paris, wherever. And then you are able to report by location. If you had to report by location and Sacramento was part of your department description, then when you wanted to report on everything in Sacramento, you'd have to go for your HR for Sacramento, you'd have to go for your payables for Sacramento, you'd have to go for your receivables for Sacramento, your assets for Sacramento. So you'd have to get many different account values or department values that were not in a nice, neat range, and it would be much more difficult to do. The second criteria is information is not repeated. In the olden days, when people first implemented Oracle, they made their chart of accounts look exactly like their legacy system. They did not have subledgers like receivables, like payables, like projects, where they could put specific information for that module. So you don't need your customer information in your chart of accounts because that's in receivables, it's in your parties, in receivables, all of your revenue, all of everything that has to do with a customer. You can see balances, you can see aging. You can see that out of the module that exists specifically for dealing with your cash management, your receivables, your profitability by customer, those kinds of things. So you don't need to put that in the chart of accounts. If you're implementing Oracle projects, and this is a big one, in the olden days, you used to put a project segment in your chart of accounts because Oracle projects did not have the reporting and the tracking that you needed to report on long-term projects year over year. Projects has come a long way since Oracle first introduced it, and now you can get all of the reports that you want, all the detail you want, and in the kind of format you want so that you can track your projects year over year. You can budget at your project level. You can use your resource allocations at your project level. You can receive, you can pay from the project's modules, and it's integrated with all of the other modules of EBS. So there's no need to put it in your accounting flex field. That's just redundant information, and it's hard to track, and you won't get the reports you need straight out of Oracle without doing custom reports and enhancements. So if you're implementing receivables, you don't need a customer segment, you don't need employees in your chart of accounts, implement HR instead, and we strongly recommend that you implement projects instead of having a project segment in your chart of accounts. Third criteria is enough room to expand. This is all about ranges, and I've got a U.S. example. I apologize. Most of my examples are U.S. We're based out of Orlando, Florida. And this is the, I've given detail here for a location segment. In this example, at the bottom here, I've got my first digit is my country here. So U.S. is 1, Canada is 2. My second digit is a region. So I've got the Midwest region that falls into the U.S. country. I've used 1 digit for that. In the third line here, I've got an area, and I have 1 digit for the area. So my third digit represents the Detroit metropolitan area. It's 1. And then my last 2 digits here represent cities within that area. What this is saying, and the way you determine this structure for growth, is that I will never have more than 99 cities within a single area. I will never have more than 9 areas within a region, and I will never have more than 9 regions within a country. If you have more than that, you have to allow for growth. So if you have 110 countries, it's going to need to be 3 digits for the beginning segment. For the beginning value. Okay. If you have more than 9 regions within a country, then you would have to have maybe 2 digits for 99 regions within a country. You want to do this without allowing alphanumeric in there, because alphanumeric is hard to report on, hard to get into a nice range, and it's hard for your data processing people who are used to using the keypad on your keyboard to do data entry. It slows them down a lot if you have alphanumeric. Okay. If it's a slow-growing area, we want to space this out with increment by at least 5 within each group. So that means if you're going to quickly grow the number of cities, which is not likely in this example, you would want to increment by 10, as I've done here, for a high growth area, so that you've got lots of values in between. You've got 9 values in between here. So if Ann Arbor grew and had a suburb, it'd be Ann Arbor 1, Ann Arbor 2, and so on. Okay. The maximum number of characters for a code combination string is 240. You really don't want 240 because your reporting will look awful, your forms will look awful, you won't see the end of your fields. In a lot of places it'll be cut off. But there are upper limits, but it's important to design your chart of accounts so that you have room to grow and you have room to insert things within the appropriate range. Many people who implemented early on would have maybe for their assets accounts, they would be in the 2,000 range, and then 2,100 might be their hardware assets, 2,200 might be their building assets, 2,300 might be their furniture, physical assets, but then they ran out of, they had more than 99 values in each, so instead of having all of your hardware assets be in the 2,100 to 2,200 range, they do 2,100 to 2,200, and then as they ran out of values, they started 5,380, 6,220, which means that every time you wanted to report on those assets, you had to go and find where they were located in other places in that value set. Okay. And I'm going to be showing you an example of cross-validation rules. The same would be applying to security rules. If things are in a nice, neat range, we've actually had customers go from thousands of cross-validation rules to 25 or 50 because they're able to rearrange their values. And that's getting into the next thing, and that is using a logical range. Ranging your values logically allows you to report easier. It allows you to have a better level of security, and it's much easier to maintain. Including a range of values reduces the number of cross-validation rules, makes implementing security easier, and all of your report definitions, and I use FSG because that's Oracle's standard report financial statement generator. But even if you're going to a data warehouse or if you're using Hyperion for your reporting, if it's in a nice, neat range, your reporting will be much easier. And then when you talk about cross-validation rules and security rules, you can exclude specific values if needed, and you can get down to really under 50 cross-validation rules from most companies, even very large global companies. Use numbers randomly. If you've got a car serial number and the first 4 digits are the year, the second 2 digits are whether it's a sedan or a convertible, the next 3 digits, a 2-door or 4-door. By the time you get to report on that embedded data, it's very, very difficult. It's very difficult to sort. It's very difficult to search on data that's within an intelligent number. Now we're going to go into a cross-validation rule. A cross-validation rule is across different segments, and it either allows or does not allow certain combinations to exist within that cross-validation rule. So if you don't have things in a nice, neat range, and if you don't have enough room within that range to allow for growth and expansion, your cross-validation rules and your security rules and your reports can get very complex. In this example, I have a goal of preventing my revenue accounts between 30,000 and 40,000 from being used with any department other than the following 5 values. So only these 5 departments can use the revenue accounts between $30,000 and $40,000. Okay. So we're going to go through this. The first part of a cross-validation rule is that you have to include the universe. That's an Oracle constraint, that you have to include the low and the high value for each of your segments, the lowest possible value and the highest possible value. In this case, my company segment is 3 digits, so my lowest possible value is 000. My highest possible value, since it's numeric, is 999. For department is 4 digits, so I can go from 0000 to 9999. Account is 5 digits, goes from the lowest possible is 5 zeros, the highest is 5 nines. My product line is alphanumeric, so my low value, it's 3 digits, can go from 000 to my highest value is ZZZ. So I've allowed uppercase only and alphanumeric for that value set. And intercompany can go from 0 to 999. So this is where you start for all of your cross-validation rules. You have an include statement. The next thing you have is you exclude certain values. Now remember, I wanted anything below 3001 from being used for this revenue account. So here, my company value will stay the same, 000 to 999. My department goes 000 as my low value, and 3000, these are excluded. In other words, they are not valid for department for that revenue account range of 30,000 to 40,000. And I'll be going through the rest of this example in the next few screens, but this is an important concept to understand, that you have to exclude below, and you'll see you have to exclude above when you're writing a cross-validation rule. Okay, so we did the statement for all departments below are prevented from being used for this account range, 30,000 to 40,000. The next thing that I need to do is allow 3001, which means that my next exclusion is going to be anything greater than 3001 and less than my next value, 5057. So here we go. For that next exclusion rule, I start my low value at 3002, and my high value is the value below the one that I'm going to allow. So that's 5056 are being excluded from account numbers 30,000 to 40,000, my revenue accounts. The next one goes anything greater than 5057 and less than 6,124 for my department numbers. So it goes 5058 to 6123 are excluded from using the account 30,000 to 40,000. Same thing for the next pairing. Now remember, this is only 5 different departments that I'm allowing for those revenue accounts. If they were in a nice, neat range, it's 1 before and 1 after, so it would be 2 exclusion statements. But I don't have that here. I have an out-of-range condition. So the next one goes from 6125 to 8536. I have an exclude statement there. The next one goes anything greater than 8537. So I start with 8538, go to 9904 for those same 30,000 to 40,000 account values. And then finally, I have to exclude anything that's greater than the value 99,005. So I started at 9906 to go to my last possible value, which is 9909. So here what I have is my one include statement that includes the world, and that's required by Oracle. And then in order to just exclude the 5 departments, or to only allow those 5 departments to use the range between 30,000 and 40,000, I have 6 exclude statements. Okay. Think about if that were true in every one of your segments, you had to do 6 statements to just include 5 different values. It adds up to be a lot of different cross-validation rules, and it's very hard to maintain. It's very hard to go back and say, which one did this include, which did it exclude? There are sometimes multiple segments involved in multiple conditions, so that adds up to a lot of different cross-validation rules. If these were all in the range, let's say 3001 to 3006, then my exclude statement would be 0 to 3000, and then 3006 to 9999. Okay. The last one is no reliance on spreadsheets. As soon as you introduce spreadsheets into your reporting and into your chart of accounts, then you introduce the possibility of errors, because your spreadsheet may not keep up with new values. You may not include new values that you've entered into your chart of accounts. You allow your users to manipulate the data, and that translates into inconsistent reporting and uncommon definitions across the organization. And if you have everything that you need in your EBS, not just in your chart of accounts, but within your EBS modules, there are plenty of reports within each module to allow you to track and categorize all of the information that you need without relying on spreadsheets. You don't really need to integrate with third-party reporting applications unless you have a different chart of accounts for each country or for each division or for each plant. If you've got a standard chart of accounts and you've got it segmented correctly, you should be able to do almost all of your reporting within EBS. That's the easiest and quickest way. Some of those reports are standard Oracle reports, so that saves you time. It's easier to reconcile, and anytime you introduce a change, you don't have to go back and revise a lot of different third-party applications. If you don't know how to do it, you should learn how to create a master row set for your financial statement generator reports. You can also do something similar for external reporting products, but a master row set is a superset of all of the rows that you have in your, that your company uses, that your whole finance and accounting department uses. So for instance, sometimes you may have one account that's a total of 5 different accounts in your report. Sometimes you may have those 5 different accounts in yet another report. Sometimes that row is indented, sometimes it's in bold. Your master row set will include all of the different kinds of display characteristics, calculation characteristics that you use in any of your reports. It does take a couple weeks to develop a master row set, and it may have many, many, many rows. But then when your users need a report, all they have to do is take a copy of that master row set and then hide the rows that they don't need. It takes about an hour afterwards to generate each new report, and that's a huge time saver for most customers. You can use the same principle of a super row set or a master row set for all of your other reporting needs as well. And it allows you to generate different reports without having to rewrite each report on an ongoing basis every time your users' needs change. We do have some white papers on our site, on the ePrentise website, www.eprentise.com, on creating a master row set. So a global chart of accounts is an important standard because it gives common definitions to the entire organization. Your primary ledger has a single chart of accounts, and it is the single source of truth for all accounting, reconciliation, and analytical reporting. Okay. Within Oracle, especially in Release 12, you have the flexibility of creating secondary ledgers, creating even different charts of accounts, but they all roll up to the primary ledger so that you have consistency around the world for reporting. You will be able to, that primary ledger will serve as a consolidation financial system if you've got a single chart of accounts. You can take all of your localizations, all your local reporting requirements, and roll it up into a parent account in your primary ledger and generate your reports. You can also split out your data for local and statutory reporting requirements. A lot of people require for IFRS, International Financial Reporting Standards, you're required transparency. What that means is you have to be able to drill down from your general ledger into all of your transaction data in your subledgers without going to an external system. If you're going to do that, you have to have a way within your chart of accounts to roll up that data together. It gives you common metrics and reporting structures. It gives you the ability to drill down from your general ledger into your subledgers. It gives the ability to roll up from all of your transaction detail and from secondary ledgers into your primary ledger. It reduces your costs. If you only have to configure with a single chart of accounts, that's going to be easier. If you only have to maintain one set of security rules or cross-validation rules, that's going to be easier and less expensive, and you can report within ranges. You don't need to do any conversions for your data warehouse queries, your drill down to your subledgers, or any ad hoc reporting. It allows you for a shared service center to train your shared service center operators in one way that means one thing to one customer. One of my criteria, and I usually mention it with the spreadsheet criteria, is that somebody comes into your, maybe a temporary employee comes in to do your accounting. They know exactly where to report things, even if they've not been exposed to your data before, because your definitions are common and standardized across the organization. And it allows you to allow governance, access, and control of new combinations and reduce your redundancies. In this example here, we had a balancing segment value that was across many different charts of accounts. So chart of accounts 1 had balancing segment value 01, chart of accounts 2 had balancing segment 01. These blue lines are spreadsheets that this client needed to use in order to come up with their financial results for company 1 every month on an ongoing basis. Their close cycle went from 20 days to 3 days by going to a standard chart of accounts. In Release 12, there are a lot of functions that require a single global chart of accounts. The first is ledger sets. It allows you, if you have a ledger set and they have to share the same chart of accounts, it allows you to open and close across all of your different ledgers, create journal entries to do allocations across ledgers and recurring formulas, eliminate across ledgers, do your revaluation and your translation without changing any responsibilities. You can view all of your journal entries and account balances across ledgers and report across all ledgers. That includes the data for multiple ledgers. If you're going for a global chart of accounts, I would recommend adding an intercompany segment. There's a feature in Release 12 called AGIS, Advanced Global Intercompany System, that allows you to net your receivables and payables across companies, across legal entities very easily, and your reports will show which is your to and from elimination entry. I recommend adding a segment to add or accommodate your local requirements. And I'm going to show you a screen in just a minute on how to do that. You'll have ranges or roll-ups for each country to use. Could be different divisions, but I recommend it be for different countries only. That allows you to do your statutory reporting, your regulatory requirements, and a good idea is to have a location segment. Right now, because people buy not in your in-store location, but buy online, they buy across different parts of your organization with different product lines. It is very good to have a location segment so you can do your taxes by location. You can have your cross-validation and your security rules by locations. And also you can determine with a location segment what kind of business your location is doing, what your expenses are by location, and whether that location is profitable for you. And then implement other modules for detailed tracking at a local level through an OU. That would be your project accounting and your collections. And implement multiple reporting currencies and secondary ledgers to report in different currencies. So there are different ways to handle local or regulatory requirements. I recommend having, call it either a local segment or a lot of people call it an analysis segment. What you do is assign ranges in that segment to each country or each place of localization. So for instance, I might assign France, my analysis segment ranges from 0 to 1,000. And then I might have within France value 321, which would be my French bank account or my tax account or my VAT tax account for the UK, so on. Okay. So if you can have a range for all of the local or statutory requirements for that country, that would be good. If you have too many of those, you're going to use create accounting rules. So, and create a secondary ledger. So if, let's say you have 20,000 accounts for the UK, bank accounts or cash accounts. And you don't want to have 20,000 different values in that localization segment. You don't want to have a range of values for that. What you would do is use Oracle's create accounting or account derivation functionality to get to those accounts. So you would put in a number in the range that would say, these are my UK bank accounts, and then you would use create accounting rules to define your source account, which would be in that local segment, and then go to a target account in that secondary ledger that would reflect the specific local bank account for those 20,000 different bank accounts. Okay. You can use segment rules or account rules. You can have an effective date, and then you actually map that source to the target account in your secondary ledger. You can set up those to be copy values, use a roll-up group to go from your detailed, from your primary ledger to your detailed value in your secondary ledger. And here I've used a whole range of values. Again, if you've got your values in each segment in a nice, neat range, these are fairly easy and straightforward to use and to change as you grow and change. So you can copy value, assign a single value, use a rule form, and then get into the detail and use individual accounts, or you can use a range, or you can use a parent value there. That allows you, if you set up your secondary ledgers with subledger accounting, there are 4 types of secondary ledgers. You can use one that is just a multi-currency ledger that does not drill down. It's for reporting in a different currency. You can use an adjusting ledger, which is add adjusting entries to your general monthly transactions. And the reason you would do an adjusting ledger is because those adjusting entries are what takes a very long time when you're closing. So you can speed up your closing process by putting those adjusting entries into an adjusting ledger. You can use a ledger that's balances only. That looks like and feels like what the GL consolidation ledger was in release 11. Okay. Or you can use a secondary, you can create a secondary ledger with subledger accounting. If you're going to keep your local and statutory transaction detail in local currency and you want to drill down from that primary account into the local account with the subledger transactions, you want to set that secondary ledger up with subledger accounting. And that allows you to report globally, as I've done on the left-hand side, and then in here on the right-hand side, I've got my French local. Okay. Leveraging AGIS, that's Advanced Global Intercompany System. It will allow you to do intercompany balancing, intercompany invoicing, reconciliation and eliminations, and manual intercompany transactions. There's netting between your to and from organization or your trading partners, as Oracle calls them. Having a common chart of accounts enables the efficient use of AGIS, and also having an intercompany segment makes the AGIS much cleaner. Okay. So if you're going to release 12, you might want to use that opportunity to redesign your chart of accounts if it's not optimized, or to go to a single chart of accounts if you've got multiple charts. And we've got some companies that have 25, 35, 50, 100 different charts of accounts. Imagine the difficulty in reporting and maintaining all of those different charts of accounts. As you redesign your chart of accounts, focus on the 5 fundamental criteria: 1 type of information per segment, no repeated information from other EBS modules, leave room for future expansion and flexibility, use logical ranges, and make sure that your accounting flex field is set up so that you can get your reporting natively from your EBS environment and your flex field structure. Design your chart of accounts with ledger sets, secondary ledgers, subledger accounting, and AGIS in mind so that you can take advantage of those functions and features. As I said earlier in the presentation, if you would like to work through a custom design session for your particular requirements, I'm happy to do that at no charge. You'll coordinate that through DSP, and we'll get it scheduled. It will take a couple hours for me to do, and I'll need some information before we get started, but I've probably designed over 1,000 charts of accounts in my time, so lots of experience that I'd be happy to share with you. Okay, we have some time now for questions. Has anything come in on the chat?
Jonathan, AJ, anything come in on chat regarding questions for Helene?
They're muted. AJ, Jonathan, unmute yourself, please.
Hello?
Hello.
Hi,
okay.
Is that better? Sorry about that.
That's better.
Yeah, we had a few emails come in over the build-up to this webinar. I think you, Helene, have answered most of the questions that did come through. However, there is one that I think that you did not answer, which is how do you amend the Oracle EBS chart of account structure without a re-implementation in a way that will be supported by Oracle?
Well, we have software that does that, and all of our customers, we have hundreds of customers who have changed their chart of accounts. All of our customers have a valid Oracle support agreement, and I've got a couple screens here from the software. This is your segment mapping. You can map one-to-one, one-to-many segments, and many-to-one segments. So this is the screenshot for that. I'm not going to go into detail about the software, but just to show you that we do have software to do that. And the Oracle support question, I'd be happy to discuss with you offline. It's a longer answer than that, but you will definitely still have a valid Oracle support agreement, and as all of our customers do. Okay.
Helene, we've got another question come through. Do you have a solution to consolidate 2 operating units with 2 chart of accounts to use only one, the same chart of account in existing R12 setup?
Yes, there are 2 questions here. One is, can you combine those 2 different charts of accounts? And the answer is yes. You can combine that, and that is our FlexField software that I've got the screen up here that I'm showing you. Okay. And the second is, can you combine 2 operating units? And yes, we have products that allow you to combine ledgers, operating units, legal entities, even different EBS instances. We've got software that allows you to do that too. So I'd be happy to talk to you later. Contact Rick through DSP or Jonathan and AJ, and they will be happy to set up a time when we can talk about your requirements and how you need to do that.
Great. All right. Well, thank you very much, Helene, and thank you for everybody attending today's webinar. And again, please reach out to us if you are looking and would like to have that opportunity to sit individually and discuss that. Outside of that, are there any other questions, anything else before we bid you a good afternoon? Okay. Very good. Thank you, Helene.
Thank you.
It was very informative, and look forward to having more of these